So let's just really quickly tell everybody the agenda for today. So the market hasn't done too much in the course of the past week, but there is something that's interesting happening. Saudi Arabia is sending us a 50 million barrel oil bomb, and Itai is going to tell us a little bit more about that. And one of the topics that's very near and dear to Itai's heart is this topic about demographics. And I promise you, it is going to change about how you think of everything related to investing. And for all you boomers, it'll make a lot more sense too, why your interest rates were so nuts when you were younger. And then really the point where everybody cares about for today is letting Mike talk about what Jerry Seinfeld can teach us about investing. You should definitely be paying attention. Mike knows a thing or two. Thank you, whoever signed in from the 561 number. Could you just mute yourself? That would be a wonderful thing for everybody. Thank you. And yes, so let's hop into it. Itai, where do you want to start us?
Right. So we had a crazy few weeks with oil, and we've covered this extensively last week, and we talked a little bit about it a few weeks ago too. And what we're seeing with oil right now is, again, the storage is running out. It's really approaching capacity. And at the time that this happens, oil was down about 30% today again. And right now, everybody's watching for the June contract. I think its settlement is happening around 19th of May or so. So everybody's watching that to kind of see what happens to the price, and will that contract go negative as well. And I think obviously Saudi Arabia has a vast interest in making it go negative, and it's kind of interesting. So here's this chart that I found right here. Of course, charts. So right there, we can see that the Saudis are sending 50 million barrels, actually a little bit more, 50 million barrels in super tankers. Everything from Madagascar to Brazil is expected to reach the U.S. Sometime around May. And this is at a time that the storage is already at capacity. So that's an interesting thing altogether.
So is this Saudi Arabia basically declaring war on U.S. oil?
Not officially, but they've been doing it for a while. Like they said, sure. Oh, this is for Russia, but it's not gonna. They're gonna like it if U.S. shale takes a big hit. And the thing about oil is that, unlike some other products, at the end of the day, it's based on a physical delivery that takes place in Cushing, Oklahoma. So if you're a buyer of crude oil futures and you don't roll your contract over, at the end, you actually have to either take delivery or make delivery. So what's going on right now is that you have these ETFs you might have heard of, like USO, that a lot of people say, you know what, the price of oil is really, really cheap. I'm just going to buy a bunch of this ETF. But that's a problem, because that ETF has to roll over the contract before expiration, because they're not allowed to take or make delivery. So as oil prices continue to decline, they roll it over to the next month. And then, at some point, if the storage is still full, the following month is going to collapse too. And that creates this decay that really hurts some of these ETFs.
So, and when this price, or when you're coming up on expiration and you're the one holding the contract and you're like, I don't have the way to take this oil, that's what causes the oil prices to start going negative, because you literally have to pay the other person to say, don't give me this oil.
Yeah, and that's kind of what we're seeing. So I think what the Saudis are trying to do is basically get a bunch of production out so they can't produce any more oil. And if that happens, what's going to happen if that's the case? Then potentially oil prices will rebound when coronavirus kind of weathers off and demand kind of picks back up. And then as that happens, it's the Saudis may be the only game in town. So that's kind of what they're hoping for.
Got it. Then at that point, prices potentially spike way up. They've inflicted a lot of pain, and they get to be the, as you said, proverbial only one in town.
Right. And this is an interesting piece of information, the Baker Hughes's rig count. So this is a measurement of how much supply is out there, how many active rigs are going on. This is total world rig count right there. So we're down about 11%, but you can see we're nowhere where we were in 2016 when oil reached 25 a barrel, 30 a barrel, and OPEC came together to cut supply. I mean, we're still standing at 1964, which is a much higher number. So I think that's something to watch for, to see how supply reacts to all this stuff and the negative oil price. But based on the current amount of rigs that are active and global demand still being low, this may continue to be an issue for some time.
Got it. That makes sense. Do we have any questions from people in the crowd on this?
Yeah, I guess, is there a way to buy buy an ETF or something that allows you to trade a contract 4 or 5 months in the future if you're not certain about where oil prices are now, but you are confident or long in the curve, say the September, October, November, December contracts?
I mean, you can look at the futures contract and you'll see they're in a steep contango. So those expirations will be far higher in price than where they are today. But they could potentially go higher if the contango levels off and supply gets shut down. But again, the risk that you're running is that every single contract will go towards zero with the supply problem and over capacity on the storage space. So there isn't a simple ETF you can buy because they will have the same issues as USO or something like that. So that's the biggest issue I think investors don't fully understand.
That makes a lot of sense.
Gotcha. Thank you.
No worries. Any other questions before we head into our little chat on demographics?
Do we have to accept the oil? Can we just tell them, hey, just turn around and take it back?
That's what Ted Cruz said. He literally said, turn him around. We don't want him. Potentially if Saudi Arabia had put options on that crude oil that are American settlement, which could very well be the case, a put option gives you the right to sell something at a specific price in the future. So if they exercise their puts early, they may force us to take that oil, and there will be no choice. That could very well be the case.
Got it. Cool. Well, Itai, one of the things that kind of shifting gears, this whole conversation, the reason that we're all talking today is we want to talk about everything that's contrarian. We want to talk about the things that you don't see that are super important, that are driving everything that happens within the markets. One of the things that you're so passionate about, that you're always telling me about, is demographics. And it explains so much about why certain economies take off and why certain ones are taking a dive and why we print money. Itai, can you share with everybody here a little bit the things that you've put together about demographics and why it's so important for them to be paying attention to why it matters?
Yeah, absolutely. So I think to understand demographics is to really understand what capitalism is all about, because at the end of the day, demographics is in the heart of capitalism, right? Capitalism is based on this assumption that the future has to be bigger and better than the today. What do I mean by that? It means that all companies are based on profits growing, revenue streams increasing, people buying more stuff, things growing, hiring more people. So clearly there are shifts and trends like this move from brick and mortar to e-commerce and preferences and things like that. But at the end of the day, it comes down to having more people. If you have more people, those more people are going to buy more stuff. They're going to buy more houses. They're going to buy more cars. They're going to have more kids. And eventually there's just going to be more of everything. And that's what really benefits the organic growth of the economy. That's why hitting those inflation targets and growth targets are so important. And that's why over time, demographics is key to understanding economic growth and markets in general.
Sounds great. Well, let's see some graphs. This is what you live for, showing the graphs.
Charts is my favorite thing.
Perfect.
Okay, awesome. So we'll go back into the screen, and I want to talk about here. Okay, let's start with what we call the age wave, and this is something very interesting. So we're going to look at the composition of the labor force. In blue, we have the labor force ages 35 to 65. And in red, we have the labor force aged 16 to 34. Here in the x-axis is years starting in 1950, percentage of the labor force. Very interesting, around 1980 or so, a larger segment of the US labor force was younger than older. 16 to 34 versus 35 to 65. We call this the age wave. So as the younger labor force percentage higher up here, and then whether down there. I think this is really interesting to understand because we can look at actually the different age groups in the US in millions today, because we know the population has grown. But
Itai, can you show us real quick before you go to this one? We just need to see what that x-axis is right there on the US age wave.
So on the US age wave, the bottom here starts in the year 1966.
Okay.
And
going to 24.
Yeah, and these are just pure millions.
Okay.
So the age group of 25 to 34, so-called millennials, right here. So we can see that in around 1980-ish or so, like 85 or so, the amount of younger people, 25 to 34, was roughly the same as it is today in pure millions. 35 to 44, roughly the same. 45 to 54 grew. 55 to 64 grew quite a bit. 65 and over grew pretty exponentially. And what we can see by that is that even though there was a lot of population growth during this time, most of it actually took place in the older age segment.
So you're saying we're potentially set up for some problems here because we basically have the same number of young people in the economy right now as before, but now they have to support an exceptionally larger elderly population,
which supports a lot of deficit spending potentially, and which is one of the reasons you see, Federal Reserve failing to hit the 2% inflation target year after year, and why there's been a lot of slow growth issues since roughly the mid 2000s. It's interesting that the age wave, basically the percentage of younger people in the labor force versus inflation, here in those early 80s, all the boomers were in their early 30s and late 20s. And what did? They buy houses. And that's a time where all the boomers can tell you, we've had these crazy interest rates in the early 1980s. And, there was like a 15% interest rate to buy a house. Well, the reason is that literally the entire population wanted to buy a house at the same time, and supply and demand on interest rates. There's a lot of demand for money, which would cause rates to go up. You can see that in the demographic trends.
Got it. So that would explain why you'd have interest rates in the double digits, because everybody wanted cash.
So at the end of the day, there's more people, there's more demand for stuff, houses, cars, whatever. So
does the US ever get back to any type of interest rates that even remotely resemble this?
We don't know what the future demographic is going to hold, but we can have a guess for the next 2 years. And there's a caveat to that, which if they abuse the monetary system too much, and cause, there's a potential of run on the bonds, just because if there was ever a situation where the deficits just grew exponentially, and bonds would sell off, then yields could go up. But on a pure demographic kind of view of inflation, it's unlikely. So we can actually see here the 10-year treasury yield in red versus the age wave. And those are correlated as well. Pretty well. And this is not just an American story. This is actually a global story. This is the global fertility rates starting here in 1955. 2.1 is what statisticians say is the replacement rate.
2.1 kids for every 2 people, correct?
Right.
Okay.
2.1 kids for every 2 people.
Just to maintain the existing population.
What we call replacement rate. The entire world is sitting just under 2.5 today. Here in the United States, the fertility rate is roughly 1.8 and has continued to decline through the last 50, 70 years. Japan is a known story, so I'm not going to talk about it. Germany's fertility rate was extremely low until 2015, where the Syrian refugee crisis, they opened the country up to a little bit more immigration, but it's still far below replacement rate. France, similar. Spain, 1.3. Italy, similar.
Do you think we're going to see other nations start to accept more immigrants now to kind of combat some of these demographics going forward?
I don't know. I mean, Europe has certainly tried to do that, but it's causing a lot of issues in the way they integrate different cultures and things like that. China has a lot of problems. India, people think that India is growing. So India today is just over replacement rate 2.5 or so, and trending down, and has trended down for a while. The only place in the world that has a large population growth is Africa, which is still standing at almost 5, but it's less than 2% of global GDP. So it doesn't necessarily matter for the global economy as much.
That makes sense. So if you said something to me that I thought was really interesting at the beginning of this conversation, which is that all of capitalism really is predicated on the fact that tomorrow there are more people and there's more of everything to cause everything to go up. What happens in a world, and what happens to an economic system when that no longer holds true over the long run?
Well, we don't know, right? Because all the premise of what we're told about everything about investing has this past 100, 150 years to look back at. Guess what? In the last 100 years, the world's population went from 1 billion to almost 8 billion. And, we're not going to be in that world anymore. We're going to be in a world where we're going to have much slower growth of the population, which will translate to slow economic growth. So that's why, one of the most interesting things is, if you look at the social spending in the United States, which is Medicare, Social Security benefits, and things like that, you can see that between 1960 and 2000, it was constantly in balance, which is because the population pyramid was supporting of that. And then as boomers start retiring and there's a younger population to support them, that deficit spending has exploded. Now, this is as of February. It doesn't take into account all the stuff that's happening due to coronavirus, but it's definitely going to speed up this problem a lot more, because obviously the government deficits and borrowing has to cover the difference between the working age population and the retired population. And I think that's one of the bigger issues we're going to face in the coming decades.
So printing everywhere.
We're definitely seeing that, right? Because they are using government borrowing to support that. And low interest rates are here because organic inflation has been significantly slower. And this is actually what I view as a structural problem. And we have to be careful with the way we look in investing. We tend to think that things are going to go in a certain way, but they're based on the past 100 years of history. And that doesn't necessarily mean that things are going to be that way for the next 20 or 30 years.
So let's play that scenario. Let's go out into the future, 50, 100 years from now. Does capitalism as we know it today, is that the system?
Yeah, I have no idea. You're asking things above my pay grade.
That's totally
How's this affecting from the state level, like the state of Illinois, state of New York, that has all these pensions and post-retirement benefits, and they're not able to support those?
Yeah, I mean, that's going to be a big issue. We're already seeing that as being a big issue. So, what would be the government response? So far, their response has been, we're just gonna do these QE programs. We're going to monetize that debt. We're going to push rates lower to create this growth. I think all these QE programs and low interest rates is to spur organic growth, but it's very difficult to do that if you can't print babies.
That makes sense. Anybody have any questions that they want to ask really quickly about this before we hop into our special guest speaker? What? Is that a nothing from the crowd? Okay, great. Well, then if that's going to be the case, we're going to open it up to Q&A later, so we'll be able to go into it. But I know what you guys are all looking forward to is our special guest speaker. Oh, Shane, are you there?
Yeah.
All right, you'll get the shot at asking this question before we change the subject. So what's on your mind?
I just want to say, Ite, so you think, because I know we spoke about this years before about having less people and stuff. So do you think with less people and now more printed money, even more than before, and zero interest rates, do you think this is just going to be a super inflation time where everything's just going to be super expensive? So there's going to be less people and so much money.
Yeah, it's a tough question. So basically what they're trying to do is they're trying to create that inflation because if they wouldn't be doing it, there wouldn't be any inflation because we just have slower growth and slower demographics. So they're trying to counter that with the money printing and things like that. Whether or not it's going to work, Nobody knows. It seems to have been able to work for the past 10 years or so, since 08, 09. I think it's going to be a temporary solution. At the end of the day, if they abuse the money printing too much, they can create that hyperinflation and potentially a run on the bonds. That's a really nightmare scenario I don't even want to think about. But it's definitely something that can happen, and it's kind of like what they call a fat tail event, right? If they eventually abuse the system too much, nobody wants to own these long-term treasury bonds at 0.5% for 30 years. And what happens if there's a massive sell-off on those and rates go up and there's so much debt? That's potentially the biggest black swan event. It's not really a black swan, right? Because you can see it coming. But that could potentially be one of the bigger kind of like bearish events that you can happen. But I think that's definitely somewhere in the future possibility realm things. I mean, you can't negate that possibility.
Cool.
Do you think they'll even slow it this time? Because when they turned it off, literally it all went wrong. So it's like they've created a system that can't live without QE anymore.
Well, that's been Japan since 1990. And they've basically reached that demographic point 20 years before the rest of the world did.
Okay. Yeah. Perfect. Well, appreciate the questions on this. Just for being mindful of his time, I want to quickly just give a brief introduction to our guest speaker, Mike. So Mike is not only one of the larger asset managers in the country, but he's also the author of Jackass Investing. Don't do it, profit from it. He has accomplished what we can all dream to in a career, and he's one of those people that does not need an introduction. But Mike, if you're there, we'd love for you to give just a few words about yourself, and then we've got this very special performance set up all about what Jerry Seinfeld can teach us about investing, and we are very excited to hear all about that.
Jerry, I'm coming across okay? Can you...
there you are.
You got it? Yep.
Looking great. Thanks for being
Thank
here.
you, right? Yeah, I've been trading for 40 years, and I think aside from that, I've got 3 great kids and a wife, and I got to coach pole vault for the high school for a couple years with both my boys, and they ended up with the school records. I'm taking full credit for that.
Hey, that's awesome. They needed motivation somewhere.
Yeah, that was it. So it was all because of me, I'm sure. I'll go into this, and I've got a couple breaks. I've got some slides I'm going to run through, and then I've got a couple breaks we can take in the middle of it.
Yeah.
To ask what questions we have, but there's just a few points I'm going to try to make, and I'm going to start out with this.
And Mike, just
share with you. Well, go ahead.
Before you hop into it, I just say for everybody else, so we are going to take some breaks every few minutes to ask some questions. All I ask is if you can try to say it in one sentence, that would be the perfect way to do it, because we want to be mindful of Mike's time and everybody else on the call. So right to the point would make it great. Thank you.
All right, great. Well, here we go. I'll start sharing here. Let's see here. Let's see. So I want to see.
That's an organized desktop. Nice job.
Yeah, if I'm not organized, I'm a mess. So,
I know
yeah. So I thought I'd give us a start here, and I was going to talk to you guys, but I really thought Seinfeld does it better than me. So I'm going to go into 3 clips from his 1994 episode he had called "The Opposite," and then I'll explain why I showed these.
Mike, I don't know if I can't hear it right now.
Anybody hear it? No. Okay.
Well, we all know the gist of this scene.
Yeah. So this scene is George going on about how everything he's done in his life is wrong. Every decision he's made is wrong. Every move he's made, it's wrong. So then you have Jerry pop in, says if every instinct you have is wrong, then the opposite must surely be right. And so George tests it out. He walks up to the counter, talks to the pretty girl at the counter who is looking over at him.
I think he tells him that he lives with his mom,
exactly,
and he doesn't have a job.
She said, "You were eating exactly what I was eating." And he said, "My name is George. I'm unemployed and I live with my parents." And he hits it. He gets the girl. So the point I'm making with this is that sometimes you need to do the opposite of what you think you need to do. And with investors, that's more true than ever. This is Dalbar studies. This is going back 20 years when I wrote my book and published it in 2011. This is the chart out of the book. And it just shows that investors underperform the very funds into which they invest by somewhere between 2 and 5% annually. And it's really, really consistent. And that's bond funds, stock funds, it doesn't matter. And this has held up. The most recent report from Dalbar shows over the last 20 years or 10 years, they've underperformed by 4% annually. So even during
but we've faced many different disasters in the past. Now, I've been mayor now going on 4.5 years. When I came in, we faced the tax day flood in 2016.
I'm sorry, what's that?
Yeah, I have
keep
no
going,
idea.
Mike.
Yeah, you keep
Somebody
going.
in the peanut gallery.
Yeah, whoever's out there, just let's let Mike
now
do
I
his
know
thing.
Rob, now I know what it's like when you're doing your stand-up comedy. How do you handle people in the audience like this, right?
Well, I put him on mute. That's what I'm going to do, okay?
There you go. So this is just showing that people do the opposite of what they normally should be doing. And this leads to something that I'll talk about called return driver-based investing. And what Jerry figured out was that there are certain things that can drive markets you can take advantage of. I'm going to walk into this now because what this has led to, this fact, is a lot of people saying, well, the way you invest is to buy and hold. Buy stocks, hold on to them for the long term. And they're doing that, and they're saying that because if you try to time it, obviously you're going to underperform that. What they don't realize is to the extent that they're teaching people to take unnecessary risks and to gamble with their money. And they look at the fact that over the last 100 years, the US market has done phenomenally well. But one thing I point out in my book is since 1900 to the end of the century, the 1900s, the century started with 36 active stock markets in the world. By the end of the century, only four of those had remained intact. And the rest of them destroyed investors' wealth at some points, multiple times in some cases throughout that century. One of those four was the US. So if you look back and you can see that, you could obviously understand you would have made money just buying and holding. But that's an observation. That's not an investment decision that you can make. And you can even see today why that's even maybe more important to focus on. Over the last 20 years, this is just, I put this together this afternoon, it's just 10 markets over the last 20 years. And these are developed markets. These aren't African countries that are just trying to find their way. The UK, if you invested in the UK 22 years ago in UK stocks, you'd be flat right now. You wouldn't have made any money. Netherlands, 22 years. Spain, 30 years. Japan, 33 years. It peaked in 1989, the last day of the year, and it's in a 50% drawdown from that point. So you're sitting there for 1.5 generations, essentially, not even not making money, but losing half your capital. So the idea of buy and hold, it's not a strategy, the point I want to make. It's just an observation, and it's a high-risk observation that's really gambling. So what you need to do is focus on what the underlying return drivers are in any investment you make, determine if they're still valid. It's not necessarily the same today investing in the US as it was in 1900 when our GDP was $20 billion. Today it's $20 trillion. And as Itai was pointing out, the demographics are totally shifted right now. We've got headwinds with demographics, not just in the US, but globally. So we don't have that same tailwind we have for capitalism to just grow because the economies and the populations are growing. So we'll talk about return driver investing. A return driver is the primary underlying condition that drives the market. And instead of trying to explain it, I'll just jump into an example. So when you look at the US stock market as an example, you can see that, jump back, there's two primary return drivers that explain about 96% of the price action. In the short term, it's the investor enthusiasm or lack thereof for owning stocks. And that's those white bars. And it's essentially the PE ratio. If people are willing to pay a lot, they'll push stocks up, even if earnings aren't growing. But in the long term, and we're talking generations or more, it's earnings growth that drives stock prices. So if you think there's going to be earnings growth, that's great. It's a valid return driver for you to buy and hold stocks for multiple generations, but it's only one return driver. And anytime you're just betting on one return driver, it's gambling. So what I want to point out here is that this example, what we're seeing here with the short term and the long term, can tee us up for creating a return driver that we can exploit to make money in trading stocks. So here's an example for first one. A behavioral-based return driver. This is just taking advantage of the fact that we know that in the short term, less than a generation, it's people's enthusiasm for owning stocks that drives the prices. And what we're looking at, as we also know, that people do the opposite of what they should do. So this is a strategy I developed, and I actually put it in the book, and the book has a action section at the end of it where I'm very explicit describing the strategy, the parameters to use, and this is just looking at ETF money flows in and out of highly speculative ETFs like the triple leverage or the inverse ETFs to determine investor behavior and to fade that behavior selectively. So when I published the book, this was the performance of that strategy at that time. It had made money. The ETFs were only really valid from around 2007 or so. So that's when the track record started. But subsequent to that period, it continued to perform in line with expectations and then just blew it out of the water in this last period. And I'll show you why that happened. The strategy was sitting there saying, here's where we want to buy and sell. It was looking at that first long position near the end of February. What was really interesting that for me was that when the market started selling off in February, people initially sold into that. They panicked. They said, I'm getting out. But pretty quickly, they realized that this is a buying opportunity because they've been trained that anytime the market sells off, you buy it. And so we saw a big rush into ETFs in that period, which signaled a reverse to a short position because we're fading the crowd in the strategy. It sold off, and over the next month, for the most part, we remained short in that strategy until it went flat and then got long again earlier this month. And that was because of the money flows again. We saw people starting to finally panic and get out. And we ended up long, and then just 2 days ago ended up flat in this trade again. The strategies take short-term, high-probability trades based on investors' reactions and betting with their own dollars. So it's based on something that's sound, it's logical premise, it takes advantage of the fact that they do the opposite of what they should be. I wanted to stop here for some questions before I go on to the next couple slides where I talk about some more return drivers that people can exploit. Any questions at this stage?
Just what chapter in your book is that, Mike?
This one was chapter 3. It happened to be the opposite chapter. In that chapter, I talk about the Seinfeld episode and people behaving opposite. And then in the action section for the book, which is published on the web, you can see the actual parameters for the strategy.
And there's a link to the book that's sent in the chat, and you guys can all see that there.
Okay, yeah, it was the. I have, I mean, if you guys would like, you can email me and I'll send off, I have complimentary links to the book. If I don't know what you had in there, Jeremy.
I took it right to Amazon. That's where I got my
Amazon. Yeah, I mean, if you guys prefer, save the $10. Just you'll get on my mailing list. You'll have to opt out if you don't like what I send you each month. But I can send you over the links to the complimentary ebook versions.
Great. I'll circle up with you and we can send that out when we send our recap email as well.
Great.
So everybody, you're going to get a free book. Congratulations. You got more value out of this than you need.
There you go. Okay. So go ahead.
Somebody have if I ask a quick question?
Yeah, go ahead. Sure.
Okay. So I am like the furthest thing from a finance guy. I am, I've got my money with money managers. What I really focus on is very early stage startups. So the kind of thing that Jeremy, I didn't know him when he started Spot Hero, but that's the kind of opportunity I would have looked at. And obviously I would have invested because Jeremy's brilliant.
Thank you. There'll be more opportunities.
And I only invest I love the flag in the background. I only invest in Chicago startups too for a number of reasons. But I wanted to see if this is an analog really to just sort of the idea of looking for opportunities when everybody's freaking out and panicking and seeing where, because I would imagine that's more or less what you're saying, but I wanted to confirm that. When February 20th or whatever day it was, the market hit like 1,600 down. I'm like kind of panicked because it almost went down in like a week, the amount that I was looking to put in my portfolio, the amount that I was looking to put in and some in like 4 or 5 investments. So I kind of froze everything, didn't do anything. I didn't sell in the market, but I stopped sort of my investing. I took a breather for about a month, and then I came back and said, okay, new investment philosophy with early stage startups. I'm only looking for investments that are taking advantage of either current COVID experience, and more importantly, how does the world shift, and how do technologies, how does the current COVID experience push adoption for technologies moving forward? And
Chris, so then what's the direct question that you want?
I'm sorry. I guess I'm just trying to say, are you saying this is more or less be a contrarian in terms of when everybody's freaking out and and nobody can, there isn't investment dollars going into the market, that's the best opportunity to be buying, whether it's in the market or in, you know, other like startup activities?
Yeah, this is real. First of all, remember, this is one return driver, and this return driver and the data that we show up top here, this is one return driver that's exploiting one data set, which is these money flows here. Let's just see, right? So you've got, you know, a lot of different ways to look at investor behavior and try to exploit it. And this is just one. We have in our portfolio, we trade about 50 different strategies based on different return drivers. So this would be one of those, and it's short-term and highly selective. So it wouldn't be something that this data from the money flows isn't giving you a long-term indication of whether or not this is something that's going to sustain for a long period of time. These trades are held, as you can see, you know, days to weeks at the most. But there might be other ways of looking for longer-term trends or opportunities to exploit. Right now, I mean, for example, we're seeing money flowing into equity ETFs still. We are nowhere near a bottom at this point based on the indicators that our strategies have. People are still viewing this as a great opportunity to buy right now. And that's not a market bottom. I realize we had that big spike down, and for all intents and purposes, that would indicate a bottom, but I don't see that behavior. I don't see that in people's personalities and in the sentiment, you know, right now. But this is just one. But yes, this is taking advantage of that kind of investor behavior to fade the crowd.
Again, in the short term, sentiment drives investing, but in the long term, maybe it would be more fundamentally based, or whatever people want to think of it.
And that's a great way to look at it. I mean, the first slide I showed, or the earlier slide I showed, you know, with the you know, what drives the stock market, you know, and it's sentiment, but in the long term, there's the fundamentals, the corporate earnings growth that's driving the market. So there's different return drivers for different periods for each market that you're looking at.
Got it.
Okay.
Cool.
All right, so let me jump ahead. So I did want to show then the last part of this slide does show the money flows and why these long and short trades were signaled. And you can see the flows out of the equity market, you know, in late February, which is where the long positions put on. A lot of flows in though, a lot of flows that came in for extended period of time there when the market was selling off dramatically. People kept buying it, saying it's a better opportunity today than it was yesterday. And then they didn't reverse that until earlier this month. And essentially they're back to the even now. They really aren't looking at this as being anything they should be panicking about. So now if we go on, we can look at some other return drivers here that I just have 4 other groups of return drivers that I classify. They can be classified in any number of different ways, but this is one I put up just because this was something that people followed, traders followed for decades, maybe a lot longer than that. But, you know, I was aware of people doing this in the 50s, 60s, 40s, you know, and then it became discovered by academics around, you know, the 90s. And all of a sudden, you know, it got written up in papers. Everybody said, oh, it's a real valid factor, you know, as they call it. But it's just taking advantage of these fat tails, you know, that people tend to jump on trends and, you know, extend trends longer and farther than they should. And you can take advantage of that. And those trends sometimes can be short, but, you know, other times for days, months, or years, or generational on end, as we've seen with, you know, bond market trend. Another example, fundamental strategies. So this gets to your point a little bit, Jeremy. I mean, there's, you know, ultimately you would think fundamentals drive markets. That is the case, but ultimately maybe 20 years or longer. This is just showing a strategy that we have in our portfolio that's looking at marginal cost of production. And it seems like this should be a really sound, logical strategy because you're buying markets that are trading at or near or even below their marginal cost production, assuming then that you've got some sort of a downside protection on price and an asymmetric return profile where it could go a lot higher on the upside. This is probably the one strategy we've made money on this over time, but in the mid-teens, 2014 through 15, we got crushed in the strategy for similar reasons that you see happening right now.
Mm-hmm.
Markets sold and remained below marginal cost production in a lot of cases. This can't be, I know you guys covered this a little bit earlier before I talk, but it's not a strategy that you can use in a high contango market where the deferred futures contracts are trading at substantial premiums to the cash market because you can't trade it. This is predicated on you being able to buy a contract that's 1 or 2 months out that's somewhere near the cash price today. So it's not something we're employing right now just because structurally it doesn't allow it within the format of the strategy. But we're not employing this right now in the energy complex. Maybe we would be if there were it wasn't so steep contango. Event strategies. This is something I traded a lot in the 80s on a discretionary basis where you're just looking at market reaction to events, Fed actions, employment reports. And what you're trying to find is the market's reaction to that's counter to what the long-term trend of that market wants to be, or the longer-term trend. So a lot of times you'll get that knee-jerk reaction, employment report comes out, bond markets sell off, and then they start rallying, and over the next week they keep rallying. Well, you want to trade in the direction of that trend of following the knee-jerk reaction. It's a strategy it's worked really well over time.
So let's take a quick event that may have happened over the course of the past month. What would have been a trade that would have been in alignment with that trend that may have worked?
So we've had we haven't had anything triggered here. I'm looking at, thinking through what we've had over the last month. Because mostly what we're looking at is that knee jerk that's sort of a counter trend move. And nothing's dominated. The reports that we look at have been so dominated by other information, COVID counts, things like that they haven't been dominating themselves. They really kind of come out more in a normal market where people care about what the employment number is, but that's been so dwarfed by the Thursday, the claims filings that, the first Friday employment report is meaningless now. So nothing much in the last month.
What could we argue that we've been in an uptrend for a decade and it's just so ingrained in investor psychology that on a longer time frame, COVID is this kind of knee-jerk reaction to some bad news, and because money is so cheap, they're just going to go right back into it, and over time just buy it right back up.
You could make that argument. I think at some point, and I think you'll see that, but right now it seems like to me stocks are tracking a classic bear market path, where they had a nice big sell-off, they rally out of that, people starting to be very comfortable. But ultimately over the next 6 months, I think you have sort of the truth settling in with what that means for the economy and cash flows and company bankruptcies. So I think over long term, maybe, yes, but I don't think over the next year that's setting up a buying opportunity yet.
Kind of like an ABC move. You sell off, you retrace about 50 to 60% from the sell off, and then you make a C leg down.
Yeah, I think we're in a right now in that perfect, kind of model that we're following for that.
Just be aware that when Mike says you could make that argument, that basically says he disagrees with you, but he's being very nice about it.
No, I mean, I tend to agree with him, but I like to try to cover all my bases, right?
Right. Yeah. I mean, the key here, and the fact we're having that conversation is interesting, but what I find is that when I talk to people about investing, that's their entire focus. What direction the stock market takes should be, I don't know, 1/50th of their focus. They should have all these other return drivers in their portfolio to help diversify their risk. And if they're basing it all on a decision on whether stocks are going up or down, that's not investing, that's gambling, because you're taking unnecessary risk to try to earn a return. And I'm going to jump into that here in a minute when I start showing some of the other data. But that's my whole definition when I wrote Jackass Investing of Jackass Investing is taking unnecessary investment risks.
I totally agree.
So the last one I'll jump on here is just a directional arbitrage. I call it directional. So it's not pure arbitrage, but it's using relationships between markets to take a directional trade in one of those markets. So you can look at, if you've got a fungible replacement like I put up in here for corn versus soybeans and animal feed. If you see some big differentials in pricing going, you know that it's going to help. At some point, they're going to come together, and you can take a directional trade in one side of that if you'd like. Interest rate arbitrage in currencies is similar, and futures market term structures. Right now, you could really argue, and I know a lot of people are looking at buying energy because it's so low, and I've gotten multiple emails from friends of mine, people that aren't investors at all, that have asked whether or not they should be buying oil right now because it's so cheap. And to me, for one thing, it indicates it's probably not a bottom. But the other thing is that the term structure is showing that you're paying 50% premium for 6-month out contracts over cash right now or more. So this futures market term structure is saying really you should be shorting those futures contracts, those deferred futures contracts, in anticipation of them converging with cash price today.
To zero.
Yeah, and this is right. And this is one of the things I actually agree with the free market, or not the free market, the efficient market guys, the FAMAs of the world, who said that today's cash price is just as predictive of next year's cash price as today's 1-year futures price. So essentially, it's kind of random where that futures price is predictive or not. And based on that, if the futures price is way out of line with the current cash price, trade it for a convergence to the current cash price, and over time that will make you money. Just another
is there for people who are maybe not as sophisticated, is there any delta between the futures price and the current spot that kind of tips you off to say
there's a huge delta? The contango is like 50% or more 6 months out. So.
I guess I'm just saying in general, like, hey, what delta do you start saying, like, with any type of commodity that, like, hey, now we're in an interesting place?
So with us, we set it up for all the models that we have are generally based on the relationship of the current differentials or pricing or whatever to historical norms. And right now, yes, that's out of line with historical norms. So it's saying this is really interesting. Some markets are a lot tighter than that, but other markets like the oil markets have tended to have big shifts from backwardation to contango over time. So we need to see more differential in those to take a trade. But now it's signaling a trade now on the short side for the deferred contracts.
I mean, you could potentially just sell the 6-month future and just buy a call to offset in case there's a spike.
That sounds like an E-tie trade. Don't do anything without a hedge.
That is an E-tie trade.
Exactly. No, exactly. I think it makes a lot of sense. That's a great trade.
Cool.
All right. So this shows how the effect of that and our trading. This is about half. This was our actual trading. Half of it was in the middle. Was when I was starting and running some internet startups and not doing active trading. But through the 90s, we traded very actively. One of the larger CTAs through that period, and through the teens. And you can see that period I talked about with the mid-teens there, where we had this drawdown, and this was really some of the fundamental value strategies we had that just didn't work in that period. But over time, you're going to end up with better returns and less risk with a broadly diversified portfolio, diversified across return drivers, than you're certainly going to get with a single bet like buying stocks. And that leads me to my next slide. So here's the risk return, a return to risk of stock market. So this is the S&P 500. This is going back 30 years, but it's not that dissimilar the further back you go. I mean, the drawdown will get bigger if you go back 100 years, but for the most part, you've got close to a 10% annualized return. This is what I'm looking at is the total return index, so it includes dividends. And you've got, say, 50% drawdowns that happen in there. This is what I refer to as gambling. This is what most of the investment wisdom out there is teaching people to do, is you buy this and you just hold on to it and you ride through those drawdowns. What I'm going to show here is some simple ways to fix that and make it better. First step would be to go and say, okay, let's do an e-tie. We're going to add some put protection to this. This is a very naive put strategy of buying an at-the-money put at the beginning of each year and holding it till expiration, repeating each year. What I find that's most interesting about this is that it has a dramatic impact on the size of the drawdown. It reduces it by 60%, but it has very little impact on the overall return. And this is something that's just so important to point out, because the cost of those puts, it averages about 5% or more per year to put that put protection on. But because in the big drawdown periods, you reduce the size of those drawdowns, and now you're recovering from a much higher level, doesn't cost you 5% a year. It only costs you 0.8% per year in return to get that protection. Then we go ahead.
That's an at the money, just to repeat, that's an at the money put that you're buying at the beginning of each year.
That's correct.
And avoiding drawdowns is much more important than making higher returns, because if you lost 50% on your money and you had $100, now you have $50, so you need to make 100% to get it back. People seem to forget that math.
Exactly. So, yeah, it's huge, and I'll jump to another slide in a minute, and you'll see that in action. So now what we're doing is all we're doing now is we're saying, all right, well, let's fix this problem of this S&P being a gambling deal by putting the put protection on to protect the downside, and then adding what we were doing with this broadly, globally diverse return driver-based trading as an overlay to it. So for the same, say, $1 million investment you put in the S&P, you can add the put protection and the overlay. So you still have $1 million invested in the S&P with $1 million put protection on it, and an overlay that pays for the put protection during bull markets. And you still get all that downside protection. So what ends up happening is you end up with a much higher return with a much lower risk. So people talk about, no free lunch. Well, the very fact that you're reducing the return is what's increasing reducing your risk is what's increasing your return. So it's not that you can't get reduced risk and greater returns. The fact that you get reduced risk creates the greater return. That's the part that's missed so much with all this no free lunch talk. There's absolutely a free lunch. And it's all because the risk is reduced that you get the higher return. This, what I'm showing here, I'll explain, is what I call risk replacement. It's something we just really started thinking through over the last year. And this came up because we had a large family office that had over $1 billion in long equity exposure they wanted to hedge. And we went through a number of different methods with them and looked at some of the commercial options that were out there, and we came up with what we're looking at is risk replacement. And essentially what we're doing then is we're saying we're taking that risk associated with earning that 10% return in the S&P 500 with a 50% drawdown, and we neutralize that risk with the put protection. And the reason there were any drawdowns at all after this put protection is because we have this naive strategy. We're not adjusting it. So if the market goes up 20% after we put that put on and it falls 20% by the end of the year, we've given up a 20% drawdown, but it's still back where it was at the beginning of the year. But so what we've done for a cost of say 5% a year is we've neutralized that risk associated with the equity return of 10%. And now all we need to do is put something in place that earns us 5% a year to pay for the risk of the put protection. So we've taken 10%, the risk associated with 10%, replaced it with a risk associated with a 5% return. So we've replaced that risk with something that is half as risky, not counting the fact that then you diversify across more return drivers and it reduces it even more. So you end up with greater return, much smaller drawdowns, much less risk, just through this process of risk replacement. And this is what it ends up looking like when you turn it into a portfolio. The green line just shows how the return improves over that decade. This is the 2000s. We had two dramatic drawdowns, and now you can recover from those so much quicker, as we were just pointing out. Instead of having 50% drawdown and needing 100% to recover, you've got a 20% drawdown, and you're up 30% or so, and you're back to even. And by the time you're up 100%, you're back up 64% in a new high ground. So the fact that you reduce the drawdowns is what increases the returns. This is the numbers on that. And this is the point I really wanted to stress. You're not getting higher return with higher risk. You're getting higher returns precisely because you've taken lower risk. And what's nice is you can end up with the same kind of performance in bull markets that you would normally expect to have, because again, you've got the return driver, this overlay on top of things that's paying for the put protection, so that even during a bull market, you can keep pace with the bull market. This is the 90s. That was our actual trading in there that was reflected in that. And here's the 2010s. Again, it's our, our actual trading. You can see, that drawdown period we had with our own trading, through the 14-15 period. Oh, sorry. That is, still pulled returns down a little bit, but it's, kept pace through the entire decade. And then you take it the next step. Here's what it's done in the current market collapse. The red line is the S&P 500, and the top line is the protected, product that essentially is the S&P 100% long with the put protection and the overlay in place to pay for that put protection over time. So I just want a quick recap on it. Everything's based on a return driver. There is no such thing as intrinsic returns. You'll hear people talk about, and academics talk about, the risk premium, which is their way of trying to explain why stocks earn more money than bonds over time. They're saying because it's riskier. All you need is a simple thought experiment to just bury that. Essentially just think, if stocks over the next 50 years continue to be risky, but earnings growth does not materialize, are stocks really going to continue to earn more money? No, they're not, because over time they're dependent on earnings growth to go up. So they're not going up just because they're risky. There's an underlying return driver that you need to understand, and then you can exploit it. You don't need to take unnecessary investment risk. That's just gambling. Buying and holding stocks, having single bets, not diversifying the portfolio, truly diversifying across return drivers, is gambling. A lot of people talk about, I got a diversified portfolio, I got my European stocks, my Asian stocks. They're all dependent on the same underlying global growth as a return driver. And then the final point, and I think the most important, not only is a free lunch possible, but the act of lowering risk in itself increases returns. All right.
So Mike, awesome. Why has everybody believed this lie and just gone down this road for so long when the complete opposite to be true?
It's interesting. I think it gets back to this. They have this behavior, and they're trying to figure out what can they do. And it's interesting because they box themselves into saying we have certain things that we can do for investing. And they can buy bonds, they can buy stocks. And I hear this all the time. I have nothing else to put my money in. What else can I do? I have stocks or bonds, so I have to be in stocks. I need to make a return. Bonds aren't going to give it to me. They immediately think that's all they have as an option. And I don't understand why people want to simplify to the point of being stupid, but they do. All I know is it gives opportunities for everybody else that doesn't think the way they think.
Yeah, and I will add to it too that I think Wall Street wants you to be fully invested because that's how they make their fees, and that's a big thing. So then they wanna sell that, and they sell specific charts that show that, because if that wasn't the case, they wouldn't be making their management fees and things like that. There's a ton of there's a huge industry into stock analysis and research that they sell. So that's definitely a part of it. The second thing I think is just because the level of sophistication required to achieve that through futures and some options trading to get there, that is a step up in sophistication from what the average person does.
It's absolutely, and so we've gotten the feedback we got on what we've been getting on what we've been doing. It's twofold. One of the big investment firms, the head of retirement there, said this is a game changer for the retirement industry. Anybody 55 or older has to be in this product or similar product, that someone else will, copy, that provides the protection and the diversification and the upside all in one package. The other side that we get is this is too complex. I don't want to go into something that's complex. And my response to them is twofold. One, yeah, it is complex. I mean, we've got 40 years of what we've been doing built into this. the other side, so is the S&P 500. Any single company in that is probably at least as complex as what we do with our trading. You don't sit down and try to understand every aspect of what they're doing. You try to, figure out, does it make sense in its entirety? Well, that's the same thing here, but it's just a way for people to not have to think about it. I can tell you what's going to happen because I've seen this over the decades. People, when we first started showing this to people earlier this year, we were selling it as protection, and nobody wanted protection. They viewed it as, well, that's going to truncate my downside, even though you could show them maybe that's not the case. Then when it collapsed initially, I got this, oh, I already missed it. I wish I had been in it, but I already missed it. And in their mind, it was all over. They didn't need protection again because now they just want to ride the upside. What's going to happen is, as things go into either a malaise or a bear market over the next 6 months, we'll start getting those people coming to us saying, okay, what can you do for me now? It's just a pattern. I've seen it over the years. People will finally do what they need to do at the opposite time that they should have. We just try to make it easy for them so we don't impede their upside as well.
Hey, Mike, can you just speak a little bit about the overlay strategy? Are you basically like selling call options to pay for the puts? What can you tell us about that?
No. So the overlay, Rob, is really just this component here, which is our globalized multi-return driver futures trading strategy. So the options are only in the Brandywine Alpha Hedge, which is the long equities, long the put, and then the alpha overlay. They're only in there for the protection exclusively. And the alpha overlay portion is the futures portion. And we use futures in this because we can do it as an overlay. So the same $1 million that's invested in equities is used to be, do that, that risk replacement process.
You're able to leverage because they got $1 million portfolio, so they can margin out a little bit for your strategy.
Yeah, exactly.
They keep it at $1 million, but they're leveraging a little bit, and with the futures.
Well, I wouldn't call it leveraging because what they're doing is first eliminating the risk, right? So we're taking the risks that they would have had during that 10% return in stocks, eliminating that with the put protection, and then replacing it with the alpha overlay that has to pay for the 5% cost of the put protection each year. And we wouldn't even need to do that if people would maintain that put protection during a bull market, because as you saw, it had very little impact on overall returns. But our belief is that if you're going to do something to reduce risk in a portfolio, it better be to increase returns. You can't spend risk-adjusted returns. So the fact you earned less money, but you had a lot less risk, it doesn't pay for the kids going to college. So
how are you going to handle when you're putting on, because you and I talk a lot, when we're putting on these hedges at the end of the year, I can't remember hedges at 20. How are you going to,
Are we going somewhere?
how are you going to pay if it's going to be, VIX at 40 at the end of the year? Have you all looked at what that scenario is going to look like? And at the money option, that's now going to cost you 14% instead of 5%.
Well, it actually, in this latest bump we had, they only went up to about 8%. You went out to, and if you went further out, you could get it a little cheaper than that instead of a 1-year option, but you're locking in multiple years of a higher cost. But again, because what happens generally in those panic events is you'll get the spot VIX going up to 80 or 50 or 60, but 1 year out or 2 years out, the puts are reflecting a volatility that's, maybe it's gone up 50%, maybe it's doubled, but it hasn't gone up anywhere near the same as the spot VIX. So it costs more, but you don't have anywhere near that kind of cost increase to it.
Do you use S&P futures as your index tracking, or do they have actually a basket of stock?
So we set up a fund that we're just raising right now, and that's set up with the actual equity exposure being an ETF, and that's for tax efficiency. And then the put protection, the overlay, is all in the futures, and that's again for tax efficiency. So what you end up with is if we just match the S&P return, it's no different than you had bought an ETF. But if we outperform it by 10%, that 10% outperformance is taxed under 1256 rules, as if 64% of those gains, 60% of those gains are long-term and 40% were short-term. So you get a tax advantage to having the excess return being generated in the futures market.
Because futures options are taxed that way, right?
Correct.
Right.
So yeah, so if we just perform the same as S&P, it's just like you bought an ETF.
Well, just an interesting thought in the event that the VIX is pricing those puts a little bit expensive, you can potentially short a little bit of ES futures and sell expensive puts against it in a way to offset some of that premium and reduce your cost. But just got to put it in a model.
I like that. What we did for the purposes of putting together, the simulations, because this is hypothetical. We haven't been running long equity with put protection in our trading for the last 30 years. So it's hypothetical data, even though we've got 15 years of that with our actual trading, which is the alpha overlay portion. But we just did it in a very naive way. The actual process we use for the day-to-day trading of the hedge, it's a bit more complex. Again, we don't want to get fancy with it because we just want to make sure it's always on, causing that protection on the downside and preventing those drawdowns. But some of the things that you're suggesting every time make sense.
So, Mike, for people who don't necessarily have enough money to get into a fund like yours, and they have people either managing their money or they're doing it themselves, if they want to get that alpha return that you're kind of talking about, your secret sauce, is there any type of like cheap poor man's version that they could use in conjunction with the put?
There is. I mean, we set up two funds. One is for the overall alpha hedge, and the other is just for the pure alpha, we call it, the overlay portion. They're both set up for $100,000 minimums. So we're trying to be as good as we can for getting, the lower end of the market in there. It's not a mutual fund. I understand that. It's not $1,000 investment, but it's not 5 million. Like our managed accounts are 5 million.
Got it. Well, we can, if you send me links, we can share all this information with everybody afterwards. I'm sure there's people who are very interested.
Oh, great. Yeah, sure.
Yeah, absolutely. Other questions from the crowd?
Yeah, I've got one. What's the mechanics of the put? So you buy it at the beginning of the year. If like this March, the market drops significantly, do you sell it at that point, or how do you take advantage of it?
Right. So in the simulations we have, nothing's taken place there. It's a naive strategy that buys and holds till expiration. In the actual execution of it, we do have a little more sophistication in it, but again, we want to make sure we're fully protected. So what we're doing there, one example, is overhedging more out of the money, to some extent. And the idea there is that is providing the opportunity in real time to take some profits off the table and still maintain the 100% hedge, on the portfolio. So there's a little bit, and we kind of allocate about 1% annually in cost to those additional put strategies in the portfolio, but we always maintain the underlying at the money put to make sure we're protected.
Got it.
So you would do that even if the market has fallen 50%?
Yeah, we maintain that because we're not trying to market time it, right? So the whole intent of that put that's on there and stays on there is if the market falls 50%, and I don't know, maybe it falls another 50%, it's down 75.
It did happen before once.
Right, it can happen, and the last thing we want is to be in a position where we say we did not protect you, because that's the full purpose of what we're doing with Brandywine Alpha Hedge, is to protect the downside. We know that protecting the downside will take care of the upside, and over time we'll have that, that magic combination. I like to say it's not magic, it's just math, but the combination of those lower drawdowns and higher returns. So we keep it on. We don't try to guess whether or not that's the bottom or not.
Got it. And Mike, for some of these people that want to get their own education, as fast as possible about downside protection, just using some of the basic things related to options, what resources do you think that they should be reading or getting into that can kind of help them expedite that process?
I would think, Rob Ross may have a better answer to that than I do. He specializes in options trading. We just did what, for our specific portfolio, we don't trade options for clients. It's incorporated in the product, but I don't know if Rob, you have any suggestions?
I think the Bible of the option markets is a book called Macmillan on Options, and he just wrote a new version within the last year or two. The guy's been in the industry like forever, and that's a good, complete, almost like a college level primer on everything option strategy. The other thing I would just quite frankly say, anybody can hit me up if they want to ask questions. Itay and Jeremy can forward the information.
Yeah.
Is the internet just has a lot of stuff. What Mike's talking about is just a very basic strategy of just buying an at the money put option against the portfolio. So some of you guys out there that you just have long-term investments, you are kind of a buy and hold person. If you just implement even that, just part of the strategy, just once a year, put it in. When the market drops 50%, you look like a hero on the golf course after that.
The problem
just a merit put, yeah.
Yeah, the problem you have on that, and we, as I was saying, that's our simulations show that, and in real life, we're slightly more sophisticated, let's say. But the problem you have with that is the bull market. In a bull market, you will lag that bull market by the cost of that put, because it's not paying out protection at all during that period. And we just saw the negative aspect of that. I don't know if any of you saw the CalPERS story, but CalPERS bought $1 billion protection that they took off in January because they were tired of paying the money for it.
They felt stupid. Yeah.
Yeah, they're lagging, having this cost in there. They forgot the whole purpose of why it was there wasn't to juice returns; it was to protect. And they took it off, obviously, because they saw the Seinfeld episode maybe, or they didn't see it. They did it the opposite of what they should have been doing. So what we do with our Brandywine Alpha hedge is provide that overlay that makes it easy to maintain that put protection, easier to maintain it, because we're not going to outperform or maintain performance with the S&P every year in a bull market, but it makes it easier to maintain it during a bull market because we have a reasonable probability that year by year we'll keep pace with the S&P, even offsetting that cost of that put protection.
Well, and what I was actually curious about is, let's say you get a 2019 or a 2013 and the markets are up 30% and you put in your put on January 1st. What do you do if the at the money put that you did on January 1st is 20% out of the money on June 1st?
So we do, again, in the naive simulations, we do nothing. In the actual, we do roll it prior. We have a formula. So everything we do is systematic, structured process. So we have a formula for when we roll that when it gets too far out, because we want to protect the downside tighter than we show in the simulations. It's our goal to have the simulations be a worst case scenario to what to expect. So we do have adjustments that takes place in there. Last year, it just happened to be a year where the alpha performed really well as well. So even with the put protection, the big bull market, the Brandywine Alpha hedge outperformed on the upside. What was already just a phenomenal S&P performance.
Right. And it is, and I'm a big fan of options too in general. But I think people should be really knowledgeable about what it is that they're doing before they venture too deep into them. Particularly with selling them, a lot of people have blown up that way.
It looks like easy money. I would never, almost ever recommend, 99% of the people I talk to be selling options to collect premium.
So picking up the pennies. One day you're going to be steamrolled.
Exactly.
Definitely. Great. Well, Mike, I want to thank you so much, and everybody wants to say thank you for making your time to be out here with us. You have done your part. You did a wonderful job. Thank you. And I will circle up with you afterwards to get the information out about Brandywine Alpha Hedge and also about the book. So you'll be sending out free copies of books to people, I'm sure.
Yep.
And, we'll just hang out for another 5 minutes here. You're free to go. You're out of jail. But we'll hang out here just in the event that anybody else has any other questions that they want to go through.
Thank you very much. Thanks, Jeremy. Itay, I appreciate it.
Thanks for coming to our little Monday night call. It was awesome.
You're getting a lot of thanks from the Peanut Gallery too. If you take a look at your chat, everybody was very happy they were here, and they were happy to see your beautifully organized desktop.
Thank you very much. I'll see you guys.
Okay, take care.
Yeah, bye now.
Hey, my mic wasn't working earlier, but one thing I was reading, because I bought some oil storage stock last week. It turned out a really nice trade based on our conversation last Monday night. So thank you. The other thing I'm starting to hear, guys, and I just want to know if anybody, is they're now starting to put oil in the pipelines. Just sticking it in there and they're not pulling it out. They're basically using the pipelines for storage. I was wondering if you've heard anything along those lines. And what we know, once again, just circling back kind of the storage scenarios, because there's several companies that they do storage.
I heard that, and from what I was hearing from a friend of mine, he said, but if they do that, that can create some really serious decay issues in the pipeline because they're not designed to actually hold that weight and just move it. So it can really mess up the infrastructure.
And do we know anything if the U.S. government's going to fill up their 75 million barrels of reserves? Have you heard anything? We discussed that the last week or two.
No, but if you really take into it, 75 million barrels is not an insane amount. With the 50 million coming in right now, it's fills up in, what's the global production right now? It's like 60 million barrels a day.
Got it. So then what happens then if there's no place to store it here? All the tankers are gone. You can't put it in the pipelines. Do people just let this spill out onto the grounds?
We may see people just burn it out.
That would be interesting. So cool. Well, I'm glad that trade went well, Rob. Thank you. And yeah, anybody else have any questions related to demographics? Anything else that you saw? Anything else that circles back to what Mike talked about? Okay.
I got a question. Like, just in terms of population growth, I made a comment in the text chat. It's always freaked me out. I've always looked at it as just like a giant Ponzi scheme. Like, we're always expecting more growth, more earnings because there are more people buying stuff. It seems kind of crazy. I mean, doesn't it seem a little bit more rational for us to find a little bit more stasis and equilibrium now in terms of like global population and how that impacts the environment, just everything in general? It just seems unsustainable for us to go from 1 billion to 8 billion and then 8 billion to, I mean, how many billion could we, like that just
that's kind of exactly the point. But capitalism as we know it is not set up for it. So the current system we've had for 150, 200 years has got to have some kind of transformation, or there's going to be something. But normally, if you look at the history of how these things go, you need to go through a shock event in order to cause the change or the reformation, right? And we don't know what that's going to be. It's probably going to be in our lifetime.
China recently, they had a one-child policy, and they've loosened that in certain areas. And also, people have to remember, I think it's something like only 2 or 3% of land on Earth is even developed, like livable where people live. So there's still, even though we got 8 billion people on Earth, there's still a lot of land around that people could spread out. So,
I think Siberia lands is for sale for pretty cheap.
You just got to convert to Russian rubles, and then you're totally fine.
Just hedge it with some call options on the futures.
There we go. Talk to Itai before you hedge your exposures. So, everybody, we want to say thank you. We've definitely gone over time. We will continue talking about stuff next week. You have my information up here. I'm just jeremy.smith at Equilibrium Ventures. So if you have any feedback about this, there's people you want to invite. If there's some individual questions you want to ask, just hit me up there. I'm going to send it right now out to the chat. But we really appreciate all of you being out here. It really means a lot to have everybody participating. So thank you all so much.
Thanks, guys, for putting this on.
Rob, we appreciate it. And great background there. That was a fun one.
Thanks for coming.
Great. Thank you so much. Thanks, Matt, Itai, number 2. Appreciate that as well. And we'll hang out, for anybody else that, that wants to ask anything else. And I will make sure that I send out a recording to everybody as well.